it's changed a lot, and definitely for the better, but there's definitely been bumps in the road, and from a trader's perspective, things have definitely improved, although still not without risk at all. But in terms of user experience and the ability to access these markets, that has improved in leaps and bounds, especially in the last 2 or 3 years. I mean, if you're aware, in the early days, there was one Bitcoin exchange called Mt. Gox. It was never a great platform. It was actually pivoted from a platform that was trading gaming cards, Magic the Gathering gaming cards. So it wasn't really built for purpose, and that basically fell over, crashed, and a lot of people lost money back in early 2014 because demand grew and it just wasn't ready for it. So you then started seeing the emergence of new exchanges come on, follow a similar business model, really structured like spread betting platforms. But apart from just having to send your cash there, you did have this additional element of having to send crypto there, and that comes with security risks and operational risks, that you're managing your crypto properly and that you're managing your private keys, and that you don't actually make a mistake and lose all of your crypto, which has always been the biggest risk. And back then, really the mantra was don't leave money on exchanges longer than you have to. If you're like using them to trade in and trade out, then fine. But, you didn't really know who was behind them and kind of, whether they were trustworthy enough to safeguard your money. And over the years, and even into this year, there's been plenty of hacks on exchanges. It still happens. It happens less frequently, but it does still happen. So that's always a risk. I mean, I think the difference now is when hacks have happened in the last few years, these exchanges have grown to such a scale and with large enough balance sheets where they've managed to make good for any losses for their clients more often than not. But it is still a risk. And I think the industry's consolidated around a few leaders, and I think it will continue to do so. On the spot market, companies such as Coinbase and Binance and Kraken and Bitstamp, these have become sort of the trusted names where you can probably safely hold funds, and people more typically do hold funds there longer term. So the space has matured, and then from those early days where it was really just Bitcoin that you could trade because there was nothing else, we've obviously seen this explosion of new assets, some good, some bad, some that will be around for a while, some that you'll probably never hear of again, especially from kind of the ICO boom of 2017. The majority of those tokens have kind of disappeared and won't be coming back. But on the same time, you've seen the emergence of the futures markets, which again didn't exist until maybe 2014, 2015, kind of leverage trading products came into the market. And now we've seen the move with CME a couple of years ago, 3 years ago, launching their futures contracts. And I guess a lot of the guys here that will know that has been a very successful contract. I mean, derivatives, like major futures exchanges have listed many contracts over the years, which have just failed spectacularly. So I think CME's just kind of taken over as in last week as in terms of open interest, the largest derivatives exchange out there. But that is really still the only regulated exchange or fully regulated exchange. We have a smaller one called BACT, which is ICE's kind of crypto futures exchange in New York, but it's much smaller volumes. And elsewhere, you have these unregulated markets. Most of the spot exchanges offer some futures contracts. Again, very high leverage there. They've kind of been, they've been good for the market because, for price discovery, you need these contracts, but some of them offering like, the ability to trade at 100x leverage, not necessarily so good. You saw sort of the recent demise of what was the leading exchange, BitMEX, some question marks over their operational standards and processes. So again, you're seeing that whole market gradually clean up its act and offer a lot wider range of assets. The options market is still small, but it's there and it's growing, both on CME and on unregulated venues such as Deribit. So all these things are healthy for the market. So compared to a few years ago, I would say timing-wise, things are much more robust, much more trustworthy, but still not without risk completely. And if you are going to be trading these things, you do need to know how to manage and secure your crypto. especially for when you might be withdrawing them from exchanges and taking them back into your own custody. So that's a critical thing to be aware of. I'll stop there for a minute, Neil, and
yeah, oh, great, Paul. Thank you very much. I've got 3 questions which I wrote down, which I thought would be of interest. To me, obviously, I've been trading cryptos, not as much, but what are the implications on tax on cryptos? Because obviously, there's been a few rumors in the US that have come out the last 2-3 weeks. Question number 1. Question number 2 is when are the best time to trade cryptos? Obviously, when we trade exchanges, we know Wall Street opens at like 2:30 and London 8 o'clock, and when they close, obviously, was the 3rd question. And the third one, which you always mentioned earlier on, was the regulation. What exchanges are best to regulate in, and also with that are the withdrawal fees.
Okay, cool. Right, okay, it's tax one, and I'm not a tax advisor, but I can kind of elucidate a little bit on how things stand in the UK. And UK, is probably mostly been, or the UK's kind of treatment has mostly been adopted elsewhere. So in the UK, they pretty much kind of rolled in kind of the guidance that exists already for trading equities, etc., whatever. So long-term holdings, which would count as being held for longer than 30 days, as my understanding goes, would be accounted against capital gains. But anything that you're trading within a 30-day period would be considered income and would be treated for as accounted for as income tax. So a lot of people have long-term holdings and then they trade independently. So you can keep them in 2 separate buckets. That if you're trading, even if you have a long-term holding, and then you use a portion of those to trade in and out within a 30-day period, you can then just kind of put your income tax into one bucket. If you then decide to go off and then just hold long-term, then you can still maintain kind of your allowance for capital gains in your long-term holdings. So that's sort of the broad treatment there, and the main thing to consider. I know there's some different treatments elsewhere in Europe, where, for example, in Portugal, as long as you're trading for your own account, it's treated a little bit more like spread betting, even if you're trading on the crypto spot market. So that can be, in the right circumstances, income tax free. In places like Germany, you've got pretty favorable capital gains tax regime, where I think if you're resident there and anything that you've held for longer than a year is actually capital gains free. But if you're trading regularly and you're trading on the spot market, it's not treated like a spread betting as a spread bet effectively. If you're trading on IG index and it's a CFD, then that's different. That would still count as a spread bet and potentially be tax-free if it's not your main source of income. But otherwise, if you're trading the spot market, it's treated, and you're trading on a daily basis, it should be treated as income, any profits. Right. With all that, I've forgotten what your next question was.
Yes, sorry, the next question was the best time to trade crypto. Is there any time, like I said, like a Wall Street opening, a live opening?
Well, no, I mean, and this goes back to, I mentioned Mt. Gox. Obviously, the guy had never come from or traded, had anything to do with financial markets, which he hadn't. And a lot of the early kind of founders of these exchanges didn't. They were techies generally, so they didn't really understand markets. And they decided on day one it would be a good idea to enable trading 24/7, 365. I mean, over time that's become or been seen as a feature. I think most of the reason that didn't happen previously in other markets is for simple things that, the exchange would need to conduct maintenance at certain times, and maybe people would want to have some time off at the weekend. But it is what it is now. But the exchanges function, in terms of outages and downtime, it's far better. Their platforms are far more robust. More recently, they've often been licensing in robust matching engines from like NASDAQ or Cinnabar or places like that. So again, connectivity, API access, all of this stuff has improved a lot. But in terms of timing of trading, I mean, I think some people have kind of analyzed that a little bit, especially over the weekend. There's been some, over at certain times, identifiable patterns and movements over the weekend. But I think that was when the market was still relatively illiquid compared to what it is today, and certain small number of whales could probably move the market around. I just think the depth has increased so much, and so many players in the market now. I mean, if you think that every kind of traditional quant trading firm, from Jump to FTX to all these sorts of guys, they're all in the markets. They're all very active. So the markets are very liquid now compared to how they were. The main thing to watch is and people do put some good analysis out on this, is where kind of market and movement and prices are being driven by the futures markets, and where it's being led by the spot market. And when things are going relatively sideways, a lot of the activity is just around futures contracts, as you expect. But the move up that we've seen since the summer in Bitcoin in particular, it was notable that was real buying activity. Because people looking at the order books, this was definitely not futures led. People were coming in, buying through the order book. And what the other very interesting part of crypto trading, which I don't think people recognize yet, but for me, it's one of the most interesting parts, is that we have all of these crypto assets, whether it's Bitcoin, Ether, what have you, moving around on these public networks. Now, you can analyze these networks and you can identify flow of funds between exchanges, or you can see when there's a big inflow of crypto coming onto exchanges, which, if people are depositing lots of Bitcoin or Ether, they're not putting it there for fun or just to store, they're probably putting it there to sell. So you can start seeing these patterns about the movements of funds flowing into and out of exchanges, which can give a clear indication. And over that summer period where, order books were just getting kind of swept through with buy orders, at the same time, shortly after, you were seeing significant amount of Bitcoin being withdrawn from the exchanges. So that gave you clear indication that these weren't necessarily short-term speculators buying. These were long-term holders buying, who were buying on an exchange and then withdrawing to cold storage to hold for a long time. So these are the sorts of patterns. I'm not sure it's necessarily time critical, but there's definitely, other indicators that are unique to these networks that you don't get in other markets. And these are things that people should be looking at more. If you are interested in that, there's a firm that some guys I know very well. There's a couple of firms that do this. One firm called ByteTree, based here in London. They do a lot of on-chain analytics. They also look at miners, who are obviously a significant part of the ecosystem. They're being rewarded with newly minted Bitcoins for securing the network. Now, also, you can keep an eye on what those miners are doing, whether they're holding onto their inventory, whether they're selling their inventory. And this gives some really fascinating indicators into future price action, or where we might be at in a particular cycle. So ByteTree would be one to look at. Chainalysis, another firm. They primarily look at kind of providing tools for anti-money laundering, but they also put out some very good research on the movement of funds across the network and what that means in terms of price.
So that is old school open interest, I suppose.
It's open interest, but it's all public, visible, and real time, I guess. And
when you say real time, it's not like open interest, like 24-hour delay.
No, I mean, what you're seeing on the exchange, anything that happens on an exchange is completely off chain. So you can't glean anything. At that point, it's a centralized operator with one big wallet holding all of your crypto. Whatever happens on the exchange is like, if there's been abuse, if someone's abusing the order book or what have you, then that's for the exchange to kind of manage and control. You don't get much visibility there. It's really what happens before and afterwards. So you're getting that sort of that first look of what might be about to happen. If a whole bunch or much higher than average Bitcoins are being deposited onto an exchange, you've got a good idea that there's going to be sell orders coming in, because people don't generally do that or hold funds on the exchange longer than they really need to. And likewise, if we've got the other side of this, which is more recent, it's been around for a while. We have fiat-backed stable coins. So we have these tokens which run on, whether it's on the Ethereum network or on the Bitcoin network, such as Tether, which is the dominant one, USDC. These basically are digital representations of a dollar or a pound in a bank account somewhere. But then you can just use the blockchain network to ping them between different exchanges without going through the banking system. You do have counterparty risk to whoever is operating those tokens. So there's a trust element, just like any bank. But then because of that, you can also you're not only having visibility of what crypto or native crypto such as Bitcoin or Ethereum are being moved onto and off of exchanges. You can see how many dollars or pounds are being moved or onto exchanges or off exchanges. So you do get an indication of both sides. If there's a big buildup of dollars or pounds sitting on an exchange, then you've kind of got an idea that there's firm support on the exchange. If you suddenly see that being withdrawn, then maybe that opens up different questions.
The last question I had was the regulation, which you did mention, obviously, with the CME being the main exchange, obviously being regulated through the certain authorities. The other one, of which one of my members who's working today asked me, withdrawal fees.
Mm-hmm. Okay, I'll quickly touch on withdrawal fees. I've not checked. They're generally lower than they were. I mean, I guess, if you're trading really small size and moving money on and off an exchange quite regularly, then it could be a problem. With crypto, when you're withdrawing, there's a fee to pay to the network when you create a Bitcoin transaction or Ethereum transaction. So the exchanges are generally charging you what that current minimum fee is, and that fee can fluctuate based on how congested the network is. So in 2017, when we saw a big bubble forming and all the activity, people were trying to send money to exchanges, withdraw money from exchanges, because the networks themselves were too congested, it pushed fees up to maybe $100 or more to send one Bitcoin transaction. That's whether you're sending $1 or $10 million. Now, if it's $10 million, obviously $100 doesn't matter. But if you're sending smaller amounts, then that became a problem. That's just a scaling problem for these networks in general. And it's, these things are being constantly worked upon. And, there's just on the Ethereum network, they've just triggered the process for an upgrade process that will improve throughput and efficiency on the network. So, in the early days, exchanges maybe were profiteering a little bit from the withdrawal fees, but I don't really see that so much now, but it does depend on sort of what size you're trading. And then just onto the regulation side, again, it was a wild west as the market scaled to what it is today, with kind of, as a market cap, so to speak, as a whole now into the hundreds of billions of dollars. Of course, regulators have come in and wanted to kind of, take some kind of action. They've generally been quite cautious not to come in. A lot of firms wanted regulation to come in because it would give them the stamp of approval. But the regulators were also keen not to rush in too fast. So definitely in the US, UK and Europe, you've seen moves this year. The UK put out some guidance recently, which is basically banning, for retail use anyway, any derivatives contracts, CFDs, or even ETNs. They basically outlawed those for retail access. If you're an accredited investor, you can still use them. But apart from that, what they're basically doing, they've required any companies in the UK that are involved in the exchange or trading of or broking of crypto to register with the FCA. So there's an actual registration requirement, which they brought in this year. They've managed to give licenses out to 4 companies, and there's about 500 companies on the backlog, which they're supposed to be passing by January 2021, and no one's quite sure what's going to happen if they're not given out, and it doesn't look like they're going to be. So it's expected they might offer an extension. But these things are coming in. It means they've got to conform with standard AML and KYC processes as if you were onboarding with any broker. But it doesn't go as far as regulation might apply. Say you had something MiFID overseeing kind of the whole derivatives markets in the UK and Europe. It doesn't go that far yet in the UK. Now, saying that, in Europe, they essentially have just put out, it will take maybe another year of consultation to see whether it's actually adopted, but they've launched effectively what their equivalent of MiFID for crypto assets. So that is going to be a lot more onerous. A lot of it applies to people that are looking to raise funds using crypto, like the old ICO model. So that would be greatly limited. But again, there will be a lot tougher kind of regulations for exchanges and brokers to comply with, but really just aligning it with traditional markets, which is a good thing. So it's getting there. It's still not quite there yet.
Right. Thanks, Paul. That's great. That's our 20 minutes up, which is brilliant. The last question I'd say, if you're a retail trader, what would you say was the best retail platform to use for cryptos?
It's not a kind of a direct endorsement, but as I said earlier, I think, you know, there's some of them that have been around long enough, are well capitalized, very well capitalized now, so they can manage the risk. You are starting to see insurance come into the market as well, so you know there's a level of insurance around facing some of these firms. So you know, in the UK, you've got I mean, one of the longest standing companies is called Coinfloor. They only offer Bitcoin trading though. They're kind of Bitcoin maximalists, but they've been around for a long time. I know the team well, so you know, they are trustworthy. And then you've got leading players like Coinbase that have got their own UK operations. You've got Gemini, which is operated by the Winklevoss twins from Facebook fame. So they're trustworthy brands. And then Bitstamp in Europe, I would say, is probably, that's the exchange that I use mostly. They've got a really good matching.
Some that are really nice.
They've you know, adopted best practice for operations over the years, so they're very good. And then Kraken as well, which is another well-respected, well-capitalized exchange. They're the ones where you can also make sure, you know, you have the ability to withdraw, deposit and withdraw in both crypto and in fiat currency back to your bank accounts. You do need to be aware that if you're depositing large sums of cash back into your UK bank account, questions can be asked. There's still a level of caution about banks engaging with crypto exchanges. It depends, and you can go up to certain limits, but if you're doing very large sums, then you may have some questions asked of you in terms of what you're using the account for. But I would say, you know, those names in terms of exchanges I've mentioned are probably the most trustworthy. If you're going off to really want to trade a really broad range of assets, where if you look on CoinMarketCap, you've got 1,000 coins listed. Those exchanges don't necessarily offer such an extensive list. Then you've got exchanges like Binance, which is probably the global leader, which will offer you every crypto that you can trade, but usually just crypto to crypto, not fiat. So that's when you might need to use like a stable coin like Tether or USDC to manage your fiat balances at those exchanges.
All right, Paul, thank you very much. I owe you a beer. Now the pubs are open.
I will take one.
Take one and a Scotch egg.
Lovely.
And I'll see you up in London soon. Thank you very much.
Thanks for having me. Hope that was useful. Cheers, guys.
Brilliant. Thank you very much, Paul.
Bye-bye.
Bye-bye.
Cheers.
Thank you.